and then I will share my screen and do the introduction for everyone. So, you guys can see my presentation now. Welcome to Enhancing the Accountant Bookkeeper Connection. Wonderful. So yes, welcome everyone. Thank you so much for joining us today. I am obviously not Tanya. Whoops, I'm skipping ahead too fast. So this is normally hosted by Tanya, founder of Cloud Bookkeeping Services and Tanya's Bookkeepers Bootcamp. For those of you who may not know who I am, I'm Leanne, Tanya's operations leader at both Cloud Bookkeeping Services and Tanya's Bookkeepers Bootcamp. If you've been a part of the series for a while or seen any of our other webinars, you probably have seen all of the accolades that Tanya has gathered recently. Most notably, we just received the IPBC 2019 Professional Leader of the Year, which is very exciting. And if you aren't aware, Tanya's now just joined their board. So yeah, so that's exciting as well to have a real impact on our industry as part of the IPBC. Some pictures, Tanya, just to share a little bit personally about Tanya. She's all about experiences and family. So you can see some of her photos there. And the official housekeeping. This webinar does qualify for CE credits through the IPBC. There are going to be 2 polls throughout that need to be answered in order for you to receive your certificate and qualify for the credit. The recording of the webinar will be emailed within 2 days of this the webinar, and the certificates will be emailed within 2 weeks. So just a reminder to kind of keep your heads up and answer those 2 polls in order to qualify for them. And last but not least, we have KATA Accounting joining us. We have both Jonathan and Bob, who we've been collaborating with for a number of years. We share multiple clients with them, and it's great because they are very fluid and work in QuickBooks Online. So that is, you know, a great skill that we love with them. We love their attention to client detail and their outstanding customer service. So you guys are awesome, and I'm going to let you guys take it away.
All right, I'm just going to bring up the presentation now. So I'm Jonathan Carter. I'm often considered a thought leader in accounting and technology. I was a member of the inaugural Accountants Council for Intuit. That was an amazing experience that really gave us a leg up. I'm an elite ProAdvisor with an Intuit All-Star, and in 2018 we were awarded the Inspire Accountant Award for contributions to and forward thinking about the industry. We're known collaborators. We love to collaborate. Actually, we don't really like to work with organizations that are just kind of fire and forget and not really about working together. You know, accountants and bookkeepers are partners in business. We're internal or external. So we'd like to see more and more collaboration. I personally have a lot of experience in the mortgage industry with some rental properties. And as a firm, we do a lot of work with e-commerce, digital and affiliate marketing, and service-based internet businesses. And I'm a member of the Japanese Canadian Cultural Center board. I was recently made treasurer just last month, and I was originally brought in for my QuickBooks expertise. Now it's more guidance and reporting, and it's very rewarding, and it's very exciting to see this organization. And our goal is to set it up so that the story can be told forever, because it's a story we don't want to forget. I'm also an avid fisherman, if you might have heard Leanne and I talking earlier, and MTG and poker player, though I don't get to do any of those things as much as I would like to. I do tend to make time for definitely getting out in Mother Nature and being on or near the water. So Bob.
Yes, sir. Well, you can see some of my background there. But what I would like to say today is just talk a little bit more about the role of collaborating with bookkeepers. Jonathan mentioned it, Leanne mentioned that we've been collaborating with Tanya for a number of years now. And it's one of the areas of our business that we like to promote, and we are interested in growing. And that's likely one of the reasons, although we love to give back, it's one of the reasons why we do these sessions and try to connect with other people who may be interested, may be challenged somehow in their day-to-day work and need someone to refer to. Which we do with a number of bookkeeping firms. So if you're listening in here today and you have a burning question or some issue, if you need assistance with a tax return, which is corporate tax return, which is one of the largest services we provide to bookkeepers, then please feel free to give us a call. And that's my little pitch for the day.
Okay, not going to talk about yourself, eh? Okay.
Well, it's all there, Jonathan. People
Fair enough.
can
read it.
Yes.
Yeah, read on the recording.
Sometimes we have to change these things up.
Yeah, fair enough. So this series this year has been all about management accounting. Basic definition, it's the provision of financial and non-financial decision-making information to managers. It's very informative. Management accounting is what I was trained as, and it's a profession that involves in decision-making, devising planning and performance management systems, and providing different kinds of financial reporting quite often. And this is a very good seminar for that, because we're going to be talking very much about the meat of what's in management accounting. So essentially, management accounting is used internally, not externally. It can be from an individual employee all the way up to the entire business or a business unit or specific product line. There's many different ways that it can be applied internally within a business. Usually financial reporting is historical, whereas what we're looking for in management and accounting is drivers. What causes things to happen? Why do things happen in a certain way? So the objective of these webinars is to introduce tools that you might consider engaging your clients with, different things that you can help to help them have insight to their business, help them be successful. They're not going to ask you about these kind of things. You're really going to have to explain why they should pay for these types of services. This is definitely in the higher value advisory services realm. And if you can make this a regular thing, you get amazing relationships with clients. There's nothing more flattering to me when a client calls to ask a question that isn't about accounting. That to me means we're really doing our job well.
Mm-hmm. And to me, management accounting is really the more interesting part of the services we provide. Regular reporting is a bit repetitive. It does have its moments of interest, but it is a little boilerplate and repetitive, whereas management accounting can take you anywhere that management has a question. And if management has a question or needs support with information, you're going to have to likely invent the way to give them the information they need. You're going to have to dig out different types of data and produce an analysis that is brand new to them, that hasn't been done before. And then the next month they have a different question and you've got to be inventive all over again. So it's it really takes a lot of knowledge, a lot of curiosity to produce useful reports.
Mhm. So these are just some of the topics that could be covered, and this is not an exhaustive list by any stretch of the imagination, but this is just some of the these are just some of the topics that could be covered by management accounting. You can see our schedule there. So we only have the one left, geographic versus industry or client segment reporting in November, and everything else, there's a lot more that we could do here, but we had to kind of pick the ones that we thought would be the most valuable for everybody who's participating. So, Bob, do you want to talk about this fantastic slide?
Sure. It's interesting how this slide, although it looks busy and there's lots of pieces to it, it's been useful for each of the webinars we've produced to kind of fit in where the particular topic we're talking about fits on this overall perspective. You can see managerial accounting over on the right side at the top. Just to back up, the perspective of this slide, you can see at the bottom, historical reporting is on the left. And as I was saying, that's the part that's a bit boilerplate, the procedures and type of analysis, although they do require some changes and being inventive, they tend to be repetitive, and your goal is to get to the financial statements. But over on the right, things become more predictive. That's where you get into planning and decision support. Today we're going to be talking about cost and analysis, and I was just interested in how many times the word cost or costing appears under managerial accounting, and I think I counted 7 times. So obviously, and we'll talk a little bit more of this, but cost accounting is one of the key focuses of management accounting. Would you agree with that, Jonathan? I guess maybe Jonathan has deserted us for a moment. Oh,
I was talking away on mute.
Yeah, I saw your mute button.
We have they're building a GO station parking lot next door, and it's kind of loud. So trying to mute when I'm not speaking. Yeah, costing is probably the most important part. Leanne and I were talking before the webinar started about how a company can get itself into real trouble if they don't cost properly and they end up selling at a negative margin. More sales means a bigger loss. So these are things that we do encounter practically in real life, and the amount of time that really should go into costing and subsequently pricing are extremely important. If you don't know how your cost structure works, how are you supposed to price appropriately? This is particularly challenging for value pricing, but we're not going to get into that today. I'm sure Tanya has lots of great resources about that.
Yes. It reminds me of a costing exercise that I did in one of the large Canadian insurance companies, where we had to go through each staff department, and there were about 400 staff in the Canadian division of this large insurance company. And we had to analyze the costs for each of the multiple departments. I don't know, there might have been 50 different departments, and apply the work they did and the other expenses to individual products. And we were very surprised, the company was very surprised when they found out they were selling term life insurance at a loss. There was a bit of scrambling when we came up to that conclusion, and of course there was pushback on us. We had to go back and review our numbers and see if we were applying too much of some department's cost to the term insurance product, and we weren't. So then I don't know if someone remembered historically why they even sold term insurance at a loss, but they came to the conclusion that as a large insurance company, they needed the full suite of products. So they needed to offer term insurance because they could get people sometimes to step up from there. And just for the credibility of their business, they couldn't be a major insurance company and not offer term insurance. But with competition, they could only charge so much for it. So they were willing to keep selling term insurance at a loss, at a proven loss. So you do get into some interesting situations when you look at product costing and profitability of different products.
Yeah, I've got a good analogy for later from something that's very current. So, all right. So our first poll between costs and expenses. A, no difference. B, costs usually refer to products, expenses to other business outlays. C, expenses need to be accrued and costs don't. Or D, expenses refer to service businesses, costs to manufacturing.
All right, so I'm going to put that up for everyone to give their answer. As Jonathan just read out, the question is, in management accounting, what's the difference between costs and expenses? So we're looking for everyone to please place your selections. Again, I'll reiterate that if you want to get your CE credit or certificate, I do need you to answer the 2 poll questions that will be in this presentation today. So we've got almost everyone there. So I'm going to give it a few more seconds before I shut it down there, guys. So just a reminder, heads up and post your answers and we'll count down. So 5, 4, 3, 2, 1. Okay, I'm going to end that polling and we'll share the results. So there you go, Jonathan.
Interesting.
Mm-hmm.
Yeah. Interesting.
All right, so I'll take those out of the way and let you guys continue.
So go on, Bob.
Yeah, I'm not even 100% ready to call it the correct answer, maybe 95%. Usually you refer to applying costs to products because you're costing out the products. So it's a bit of a terminology thing, but costs usually refer to products, and expenses. So you may have your marketing expenses, your administrative expenses for the business. That refers to other business outlays that don't get applied to products. So just a bit of terminology. And also I could point out point D, expenses refer to service businesses. So a lot of times in management accounting, when we think of costing, we think of actual physical products. But service businesses, like a bookkeeping or an accounting firm, which isn't producing a product, they're providing a service, they can use costing as well, because there are costs that are attracted to doing a project, to providing a set of financial statements, and costing applies to that just as much as it does to a manufacturing business that manufactures product. So when you think of service businesses, it's good to think about costing even applying to that business.
Yeah, with QuickBooks Online and other tools that are available out there, we can track a lot of costs specifically to different things using, for instance, the class system or projects or things like that, depending on the nature of the business, of course. And in those situations, you can actually become very, very detailed. I'm sure everybody's heard about social media, online advertising, and A/B testing. This is definitely an area where you can apply a specific measures to their effectiveness and so on. So there's a lot of ways to describe costs. I'm not going to run through all of them.
Oh, come on.
No, you don't want me to read. You want me to read every single one of these on the slide? But let's talk about some of the most important ones. So variable costs and fixed costs are two ideas that are very, very common. Fixed costs do not change with the amount of output, whereas variable costs do. And then step costs are kind of like a fixed cost that happens when you produce over a certain amount. So let's say, for instance, you have a customer who has a production facility and they produce, widgets. And then they open in order to produce over, say, 1 million widgets, they have to open the next facility. That next facility would be a step cost in your forecasting, for instance. Another important one that I like to think about is sunk cost. So I don't even think sunk cost has made this list, but a sunk cost is something that you've already paid. It's too late, it's too bad, so sad. That money has been outlaid and it just has to be absorbed through your overhead. Oh, I don't know why we got back there. Bob, did you have any others that you wanted to particularly identify?
No, some of them, I'm not even exactly sure what a definition would be. But one of the things I wanted to say is as people over time have become more and more focused on sharpening their understanding of costing of products and, quote, getting it right, the number of different type of costs that have been identified or defined keeps increasing. A specific business will find its own way to categorize its particular costs, and so this list likely will keep growing as businesses get deeper and deeper into thinking about their costing and how to control it and manage it. I noticed a couple there down near the bottom on the right-hand side, acquisition costs and maintenance costs. Those were two categories we did use in the insurance industry. Acquisition meaning the cost of putting the policies on the books, and maintenance being maintaining the policies excuse me, after they were on the books. So in that case, the insurance company has its own way of categorizing product costing.
There's one more here that I'd like to talk about that is actually probably one of the foundations of management accounting. That's opportunity cost. So if you're going to do A and A is exclusive from B, you have to decide which you're going to do, either A or B, which is better for the company. And that might take into account things such as social costs and environmental costs, especially as the carbon tax credit takes more effect. Okay. So we've talked extensively that cost accounting is the primary focus of management accounting. And there's just a little bit.
This is an example.
Yeah,
an example of that. Then the number of times you see management accounting and cost accounting both mentioned at the same time, cost and management accounting. And this was just a few examples that were very easy to find.
Actually, 3 of these books on the top left picture I recognize from my days in the CMA program, actually.
Yeah.
So unfortunately, this didn't come out terribly clear. But it's an example of just how much impact cost analysis can have. Bob, did you have anything in specific you want to talk about this slide, or should we move on to the next one?
Well, the only thing is there are a lot of dimensions to cost accounting, and you can go from the central circle out to any one of these orbital circles and get yourself lost in that particular aspect of costing and cost analysis. So when you talk about costing, it can branch off into a lot of very detailed situations and fields that you need to think about and try to manage. This is why it's obviously critical to management, and it's good for an advisor, a management accountant, to be able to think in many of these ways of thinking about costs rather than just a single one.
So earlier in the series, we dealt with break-even analysis, cost, volume, and break-even analysis. Today, we're going to look at variance analysis. This can get pretty complicated, so try to follow along. And I think maybe in this instance, because it can get fairly complicated, if you have questions to type in, just go ahead and type them in, and if we notice, we'll answer them. So I don't know why I keep talking back on me. All right. So just to recap, cost accounting is a systematic set of procedures for recording and reporting the costs of manufacturing goods or performing services in whole and in detail. So just a quick example, T1, tax return, some of the costs included might include an overhead allocation for your office expenses, for your tax software, and then of course the labor that goes into producing that personal tax return. So this includes methods for recognizing, classifying, allocating, aggregating, and reporting such costs and comparing them with standard costs. It's often considered a major subset of managerial accounting, and the end goal is to advise management on how to optimize business practices and processes based on cost efficiency and capability. And as said, this may be a choice between two different product lines or two different service lines if you don't have the capacity for multiple. All right, Bob, I'll let you take this one away.
Okay, thanks.
No.
So we're talking about cost analysis today, and our focus is going to be on cost variances. How do we create variances that are a result of creating a budget, then you compare actuals to budget, and your cost of goods sold is higher or lower than you had budgeted, and management wants to understand that because it's a complex process. Let's talk about manufacturing, building your product and selling it, and if your costs are coming out high, you can't just say there's no focus on why that's happening. So you need a type of analysis to dig deeper into the variances and be able to focus deeper and deeper into how the numbers are coming together. So this slide just kind of talks about this. It starts at the top with total profits, and then it goes on the left to unit costs, which is where we are going to be focusing. And on the other side, it goes to sales volume. So volume variances are usually pretty easy. If you sell more volume, that's considered a favorable variance. If you sell less volume, that's an unfavorable variance. But on following down the unit cost variance, you can see it splits into three pieces: labor, material that's being applied to manufacture the product, and then this weird thing called overhead, which is you can't directly attribute it right to the product. It might be something like the lighting of the manufacturing shop, and that obviously doesn't go directly into a product, like someone standing there and building something, or the material you purchase that goes directly into the product. But it is a cost that needs to be absorbed into every piece that you produce. So we usually split overheads only into variable and fixed overheads. So If you're shutting down half the shop and because you're not too busy then and producing from the other half of the shop, that's a variable cost because it moves up and down depending on how much you're producing. Your shop supervisor is definitely an overhead cost because it's not direct labor, but it's a fixed overhead cost because it doesn't move around depending on the volume that you're producing. So the focus, we're going to go through a little example, and our focus is going to be on that section of this slide, the unit cost variance, and looking at the 3 types of variances. So we've created a little example here. First of all, we're going to step back and just look at the income statement overall. And the point I want to make here is that you'll notice the middle column is your budget. So it's, I don't know of a way to do a variance analysis if you haven't already done a budget. Your budget gives you targets, target costs for labor, material, and overhead. So it's a standard that you're trying to meet. And it should be a tough standard, as we know with budgets. So you're going to have lots of detail supporting each of your cost numbers and the cost of sales in the budget. The 350, these are really meant to be thousands of dollars. So our focus is cost of sales. You'll notice that we have a variance of $50,000, and you have to report to management on what caused that $50,000, and more important, what action needs to be taken to improve the business going forward. So we're going to dig into that variance and see what information we can give to management. So just to support some of the numbers, our budget was 10,000 units at, that doesn't work out. I think I meant $35.
Yeah.
10,000 at 35, and the actual was 12,500, and I think it should be at 26. At any rate, so we can see that our selling price is lower than our budget, but we sold more units. So we've got some things that are favorable and some things that are unfavorable. The cost of sales, actual is 400. Now we know we've sold more than we budgeted, so we are expecting the cost of sales to be higher than we budgeted. But how about the cost of labor versus just the fact that we sold more units? So our labor cost came out at $215,000 versus the budget of 200. So that means that our average labor on the 12,500 that were sold is $17.20, and the budget was 10,000 at $20. I think we can see that in the next slide, but we'll just go through the materials. The actual cost is 137 versus our budget of 100. Like, we've got a big negative variance there, but it could be because of the increased volume. We don't know that at this point. And the fixed overhead, because it's a fixed cost, we don't apply the volume to that. It's just a solid number, and we analyze it in gross. So we look at what we had budgeted, specific expenses to get to the 20,000, and then we look at the actual of 15 to see why we're lower than budget on a specific line item basis. Finally, the variable overhead expenses came out at 32,500 versus 30 that we budgeted. So now each of these pieces, labor, materials, and overhead, we need to dig into them even further than this. So the first we'll look at is the labor variance. So the supporting numbers, so the actual was 215, the budget was 200, and the way those numbers were arrived at is underneath in the cell right under. So we're going to use those numbers to analyze the variances. So the volume variance is pretty easy. We use our budgeted labor rate of $20 and we sold 2,500 more than we had budgeted. So the labor volume variance is $50,000 in increased costs. And as it says over on the right, the volume variance, even though it's an increase, is actually favorable because higher volume is good. So when we think about advising management, we can't say too much about this. We just say, whatever reason we sold more than we budgeted, we got to keep trying to do that. So there's not a lot of information you can give to management about that variance. And we'll see the volume variance coming up again and again in materials and overhead. Let's just stick with labor, Jonathan. Back on the previous slide. We didn't talk about the rate variance. So the rate variance, our budget was $20 per unit. Our actual, we were able to achieve $17.20 per unit. That's a $2.80 improvement. So we have 12,500 units at $2.80 that we've saved in terms of labor, and that works out to $35,000. So you can see the total labor cost was $215 versus a budget of $200. That's an unfavorable variance of $15,000. And you can see we've broken that down into a volume of 50 and a rate of -35. So that explains your $15,000. It's unfavorable because your costs are higher. The volume variance we can't say too much about, but the rate variance, what happened that we were able to produce these items and save $2.80 per item. So you're going to have to dig into that, and this is what a management accountant would do. Why were we able to save $2.80 a piece? And for that, you're going to go into your detailed chart of accounts, obviously, and look at the detailed labor costs, both budget and actual, and find out where it was you saved money. Now, a lot of things could happen at this point. You could find that you forgot to accrue a certain expense and you have bad accounting. There's a cost that you should be accruing, which would increase the labor rate, and you have to go back and fix that. Or you could find that for some reason, one of your departments was able to do a lot better in terms of their efficiency. They put the 6 people working in that department pumped out like 30% more products than you would expect from history. So you get into lots of interesting questions, and you have to go back and ask people what happened here. Why was this department able to be more efficient? You're going to write that up, send it to management, and that gives them specific information about one of the areas of their business that they are going to want to keep repeating and to support. So it doesn't just, the variance calculations are just the beginning. Then you have a lot more footwork to do to dig further into the numbers and blow them out, and then try to enhance the lower costs and avoid where you have higher costs. So this now gets a little repetitive. Under materials, we sold 12,500 at $11 in material costs for each of them. Our budget was for $10 in material costs. So in this case, we still have a favorable volume variance. We've sold more than we budgeted. That's a good thing. But the rate variance is actually negative in this case. It has increased our costs. So we've split out the $37,500 into its two components. So again, you've got an analytical issue. You have to blow out both your budget numbers, how you arrived at that $10 per unit, and look at the actual expenses that you've accumulated. Why was the actual $11 per unit? And then it just becomes an exercise to go out and talk to people, to query why that happened. And now you're going to recommend to management, we budgeted for this in this particular area in materials, like this one supplier, we thought we could buy the nuts and bolts from them for $2 to produce a unit, but it actually cost us $2.50. So we have an issue with a supplier. We have to go to them. Maybe we're not getting a discount that they promised us. So it gives you a focus to follow up on actions that need to be taken. So finally, we come to overhead, and overhead is split into two pieces, the fixed overhead, and the fixed overhead variance here is favorable, $15,000 versus $20,000 budgeted. So it's an investigative issue again to determine why that happened. Usually fixed overhead comes out very close to your budget. It's very predictable unless your production facilities change volume by a large amount. Fixed over, like the power to run the lighting in your shop is pretty predictable. So that's a pretty large variance. And for me, just looking at that, I'd be very interested. How were we able to save $5,000? Like it really captures my curiosity. On the variable side, we had 10,000 units budgeted at $3. Again, this is exactly the same as the labor and materials variance. So the volume is favorable, $7,500. The rate variance, we've saved 40 cents on each piece. So again, you come to trying to determine why that happened. And on the favorable variances, you might say, well, I don't need to analyze those because they're favorable. But actually, those are just as important as the unfavorable, because you want to be able to embed that saving in your processes. So it's just as important to figure out why things are favorable and then try to keep that going into the future. So out of all this, you're going to develop a report to management. You're going to look at the favorable and unfavorable rate variances. You've done your work to explain why they happened in terms of the detailed accounting records and your follow-up work with the department managers to find out why things happened the way they did, and then write up your report to management, and it's going to give them a guideline on the actions they need to take to improve their product costing. So coming back, we've done an analysis of this unit cost variance. We did look at unit cost, but we also looked at the total costs in terms of budget differences. But we looked at the three pieces, labor, material, and overhead. And you can see the process that can be followed to provide good information to management, which is the ultimate goal of management accounting. I see we have 4 questions, Jonathan. Yeah, let's go to the survey.
We'll do the survey and then get into the questions.
Sure.
Okay.
I saw the first one from Dominique, and I'm looking forward to that one.
Yeah, they're all from Dominique, so she's got a lot to say on the topic. So what I'll do is let's do the poll for you guys.
So which of the following is not a product-related cost?
There we go. Okay, it's up there now. So yes, so the answers that they have laid out here is plant, lunchroom, kitchen staff, a hotel cost for the plant supervisor to visit head office, property taxes on warehouse used to store accounting records, fuel costs for company jet. All of the above are possible product costs. So I'll give everyone a moment to answer there.
And the question is, which of the following is not a cost that you would apply to your products?
Okay, so everyone's starting to answer. Just a reminder that in order to get your CE, I need you to answer this one as well as have answered the first poll. We'll give everyone about 5 more seconds to go ahead and pop their answers into that poll for us. So we'll just count down from 5, 4, 3, 2, 1. All right, so let me share those results for you guys to take a look at.
Yeah, good.
All right.
It's not.
Now,
So hotel costs and plant run lunchroom. What did you think, Jonathan? So just in terms, I usually create the questions and then Jonathan does a review. Which one would you have chosen? We haven't discussed this.
No, we have not. I mean,
sorry to put you on the spot.
No worries, but for per unit costs in traditional manufacturing, these would all be applied through the overhead allocation. That's my opinion.
So you're saying A, B, C, and D is the answer. None of them are product costs.
None of them are direct product costs, but they could all be allocated as overhead costs.
Yeah, yeah. Now, so this is where it gets interesting, and why we tried to pick costs that were out there. You certainly couldn't directly think of them being applied to products, but like when you look, and this gets us into what actually happens out there in business. If we had like 4 accountants sitting in a room in a manufacturing business and talking about the expense accounts for each of these 4 choices, let's pick plant, lunchroom, kitchen staff. One accountant could argue, well, it's only for plant personnel, so it is related to the products, so it should be applied to the products. And another person could say, yeah, but it's so unrelated. It's so far away from producing the products. I can't see that it should be applied. And fuel costs for the company jet. Well, you could say, well, a portion of the use of the company jet is to fly plant personnel, plant supervisors. So I want to do a percentage calculation of the number of plant personnel who use the company jet, and maybe we'll get 20% of the fuel costs that should be applied to the product. So in a small business, you likely wouldn't go to that extent. But in a larger business, you can get way down into the details about what should be applied and what should not be applied to product costs.
Okay.
Anything to add, Jonathan?
No, but this is exactly what you said. It's an area where you get into debate about what you should include and what you shouldn't include. And as I know you know, Bob, sometimes you get into the politics of it as well. Right? When you're dealing with different managers and different units, supervisors or directors, sometimes they want to include a cost, sometimes they don't want to include a cost, but for a reason that is not accounting related, maybe related to achieving their bonus, for instance.
Yeah.
So our job, and this is in my humble opinion, our job as accountants is to ensure the best information is provided to management. So sometimes this can create some challenges, and definitely some times where you have to either be convincing or be prepared to upset somebody for including a cost that they don't want included because maybe it affects their bonus.
Yeah. Yep. I've been in those meetings.
I'm sure you have. Okay, so.
All right, let me get this off your screen for you guys here. And then can you see all those questions? Because,
Yes.
Dominique, you've been typing up a storm, but she's got some good information there. So I'll let you take a look at that, Jonathan.
All right, so I'm reading the first question. I have a theoretical confusion about how to apply cost to QuickBooks Desktop and QBO. Most of my clients are service-based trades, techs, or professionals. When I want to add job costing using direct costs, then there are all these overhead costs that are left out of the allocation. If I try to muck around with the chart of accounts to combine groups of expenses together, such as marketing, admin, etc., then I mess up Giphy for tax and cash flow purposes. What should I do? Please help please to put into context. So one of the things that Bob and I used to do way back at our days at a mortgage company was we would have an overhead allocation. We would do those allocations, I believe it was through class systems. And essentially we would debit the overhead account, whatever it might be, credit the overhead expense account, and then debit the same account for the same total amount, but have it split out into the cost that's being allocated to each class. Now that worked well for us in QuickBooks Desktop. I've done that in QBO to a much more limited degree, but the theory behind it should be fine. I hope that answers the question. Payroll cost is another cost which I find hard to apply to services, clients, and jobs. This would require reporting of detailed time reporting by job, line of business, etc. This in turn seems to require very detailed pricing, costing, client job tracking models. Altogether, this can easily double, triple, or more the actual bookkeeping time. It's hard to justify unless I find a better way to track the direct and indirect costs. Well, one of the things I could say is T-sheets can be useful for that. That it can assign jobs to a specific, or assign labor costs to a specific job. You can do the allocations and whatnot. A lot of the times you do have to pull your information out into Excel or Google Sheets or whatever tool you use to try and actually make sense of things. It's very common. We do it all the time. The fact that it increases the amount of bookkeeping time, this is why this needs to be an advisory service that's priced accordingly. This isn't something that you would do as a normal kind of cookie cutter bookkeeping service. This is definitely something that we charge a premium for.
Another comment, maybe I can jump in here, Jonathan. Another way to handle some of these issues where you have to do allocations. You mentioned allocations in your first question, Dominique, and payroll is another example. What you can do is you don't split up the actual expense accounts. Take an expense account like we talked about jet fuel. So at the beginning of the year, you could say, what percentage does plant staff use the corporate jet for? And you might come up with 15% after looking at history, you would have to discuss that likely with management and the plant staff and say to the plant people, okay, we're just going to have a single jet fuel expense account, but 15% of that is going to be applied to the products. So you don't actually have to split up the account. You have a way, because of the percentage, to easily allocate that total balance. And you don't have to look at that allocation percent every month. So you can use it, say, for a year. And if something looks really strange, somebody's going to complain, say in July, the plant guy sees too much jet fuel being allocated to product costs, he's going to start to complain. And then you might look at what happened, and he could be very right. You have to make a bit of an adjustment for that 1 month. But I would say it's just once a year you might have to look at allocations, and quite often you'll come to December and you want to do the allocation for the next year, and it could be just as simple as, do we think there are any issues with this 15%? No, okay, we'll use it for another year. So you don't have to embed all of the cost allocations into your accounts, your chart of accounts. You can use offline methods to allocate costs.
Yeah, usually it requires a bit of a calculation. Just another example from real life. At the Japanese Canadian Cultural Center, we use QuickBooks Desktop, and we have, I think it's about 150 plus different classes that we use. And we can allocate labor, we can allocate food costs, and so on, without having a huge chart of, our chart of accounts is huge, but without it being one account per area. We can have it divided up and actually pull a P&L for each different category. Like if we want to know how karate is doing versus calligraphy classes, we can look at things on that kind of a detailed level. So it's very useful to help understanding what programs we should support and which programs are actually supporting the center. Next question. Another issue that arises is how and when to apply the tax costs. Interesting. For my trades, they seem to forget the GST, payroll, and corporate tax liabilities when they want to dip their fingers into the corporate bank, aka their personal piggy bank. Well, God knows that's never a problem we run into with small business owners, eh? Okay, so I don't really see the tax cost as being a job cost, because the taxes, it's a trust, right? It's a trust account. The corporate tax liability, you could divide that based upon all kinds of different things. But for GST and for payroll tax, yeah, the small amount of CPP and EI that are paid, those should be allocated perhaps to the cost. But most of the source deductions are coming right off the employee's payroll. So really, the cost of the company is the employee's paycheck. When it comes to GST, HST, things like that, I think it would be very similar. Maybe a little bit more clarification on that question might help me give a better answer, Dominique. All right, we are running out of time, but I'm going to keep plugging through here. Leanne, can we go over time if need be?
Yeah, I'm good to go a little bit over so that we can address these questions. We've got 3 more here from Dominique. And I'm just wondering, Dominique, you can type in if I'm incorrect, but I'm wondering if you're indicating in that GST question, like the tax question, is it a matter of like showing it almost as out of the books so that they don't overspend? Does that make sense, Jonathan? Like, it's just that if it's sitting there and it hasn't been paid yet and it's not allocated in a way, they think they have extra money to spend that they don't actually have extra money to spend.
We see this problem all the time. I don't know if that's really a cost analysis thing or is a cash flow management thing.
Okay.
But yeah, right. I see it. We do see this all the time. And please make sure this stuff can literally follow you to the grave. So
if we drop down, Dominique's kind of added in. Yeah, she's basically got clients who are dipping in and applying extra, dividends, and it's an overspending or a cost flow for that third one. So
Yeah, they see a bank balance on their bank statement, and that they can't keep their hands off it. Oh, I want to buy that new car. I've got lots of money in my bank account, so here we go.
Yeah.
One way is maybe set up a different bank account that they don't see, and periodic, but the administration of that can get pretty weird.
Yeah. Okay. Next question. Units of measure and material costs are another issue. Many trades use supplies that they buy in bulk and use in bits in each job. In aggregate, these add up. However, there's no way that they would count on a detailed basis. So I would have to find some metric as a proxy on which to apply prorated supplies materials for each job. One thing that can be great, and I think it's really going to depend on the customer, is having a standard knowledge of what each job entails. So, you know, this job means that you need 12 bolts, 1 motor, and I don't know, a certain allocation of grease. I'm just making stuff up off the top of my head here. That's one way that you can allocate that. But yeah, we do find this among smaller companies that they don't feel that they have the time or there's value in evaluating these things, but it can become very interesting. A lot of trades, they do side jobs. So if a tradesperson has hired another tradesperson and they're not controlling that inventory, they could be experiencing inventory shrinkage due to theft. And it might not seem like a big deal to, oh, I'm just going to take this widget and I'm going to use it in my personal job, then I don't have to pay for it and the customer's going to pay me, it's more money in my pocket. It is still theft, and it can really add up over time. There's one instance that I was looking at fairly recently where from the numbers, it looks like they've lost $127,000 on materials. And this is a trade. But when we started digging into the numbers, it was more of a revenue allocation issue. Now, it doesn't mean that there isn't theft going on, but it's definitely going to be a lot less shocking of a number. Going to keep moving here. I'm also confused about how to allocate the cost of sales and cost of marketing for service-based clients. The Dragon's Den talks about the cost of acquisition of new clients and the churn or loss rate. How do I set up a chart of accounts and client job costs and overhead costs to track these metrics? It seems so much easier in retail, manufacturing, and distribution businesses than allocating this to plumbers, mechanics, architects, engineers, geologists. Definitely agree. It's a very different type of customer relationship. Yeah, we're getting some pretty bad feedback.
I'm going to mute myself. I don't know, Jonathan, if maybe you can try muting for a minute.
Hello? I'm back. The sound is gone. Yeah, this is very interesting because these types of businesses, they do get some repeat business, but it's not regular. So the lifetime value of a client could be one job, for instance. Where does that sound coming? It's not me. Okay. Sorry, I got a little distracted there. As far as the acquisition of new clients, the churn and the loss rate, these are all using metrics that aren't in QuickBooks. So for instance, I mean, the loss rates can be the number of clients that you had last year, the number who returned, that's your loss. Your acquisition is going to be whatever new clients were added there, and then you're going to probably divide your marketing costs depending on, of course, where you were marketing and where those clients came from to those clients. And you can get really granular. So like you can find out if a client came from a Facebook ad or a Google ad versus an in-person networking, things like that. One of the big costs that's often overlooked in in-person networking is your time. So that's something that I would strongly consider tracking to some degree, like come up with some kind of idea of how to track it. And yeah, you can get into a lot of detail about this. And this is why you look at an app company or any kind of our app partners, they're constantly looking at these kind of metrics. The loss rate, the churn rate, you don't want customers joining just to leave. You want new clients to come and you want them to stay. So there can be a lot of different ways of looking at this, but it would not occur in the QuickBooks environment. Vehicle and travel costs are a big line item for my client. For almost all of them, except for the geologist at Wellhead, tracking travel costs to a job or client would be totally overwhelming, even though the travel costs are significant. What would you suggest? Oh, that's an interesting one. Of course, if it's specific to a specific job, that's easy. But what happens when you jump in the truck and you service 3 or 4 clients in a day? Do you allocate that 1 day worth of travel to those different jobs? That can be very granular, very time consuming. I don't have a top of my head suggestion other than using an arbitrary allocation. Bob, do you have any thoughts on this? Bob?
Let me unmute here. I think I may have been creating some sounds that were interfering, Jonathan, so I muted. Travel costs, if people are putting them on an expense report, you ask them to indicate the job that the travel is related to, and you're not going to reimburse the travel costs until they actually tell you which jobs. If the travel costs are coordinated from a central corporate location, then the people that are arranging them should get the information and record the job that the cost should be applied to. So there are ways to kind of encourage people to keep track of the jobs that the costs need to go to.
Okay, so there was a comment by Suzanne McKay-Dunn. Thank you, Suzanne. This is regarding the HST and the cash flow issue. I have them transfer 20% to an account that they can't touch, only for taxes for small businesses. Every deposit I have them transfer so they don't see it in checking. It's always there as an emergency, but saving penalty and interest from CRA is paying for my service and keeping the CRA off their backs. So that was a good answer. We've had clients who do that. We've seen the profit first model where they have 5 bank accounts. As long as they can manage it, it should be okay. But yeah, definitely segregating funds, if that's something that they're amiable to, is a great idea. And Dominique had a great suggestion here about covering cash flow reporting using the direct versus indirect method. We've not done that. We have not done that. So that's a great idea. Thank you very much, Dominique.
We love getting suggestions.
Yeah, this is a great suggestion. So yeah, let's put that one on the calendar. Thank you very much.
Perfect.
Okay, so if there's no further questions, I just want to say thank you very much for coming. And yeah, I hope that you found value in this. And more importantly, I hope you found an advisory service that you can upsell to your clients and provide them benefit and you revenue. Anything to add, Bob?
No, thanks everyone. Really appreciate you taking the time to be with us. It really encourages us to work hard on these presentations and make them as useful as possible.
Yep.
That's fantastic. Thank you so much, both of you. Lots of great information. Thank you to Dominique for all those great questions, because
Suzanne.
it certainly, and Suzanne for your comments. Really, really appreciate all of that. So thanks, everyone. And you guys have a great rest of your week.
See you in San Jose. Bye.
Will do. Bye, guys.
Bye.